Happy Lunar New Year, everyone. Year of the Horse, the animal that symbolizes energy, forward momentum, and unstoppable drive. Taiwan's economy has exactly that energy right now. GDP growth hit 8.63% in 2025, the fastest pace since 1987. Wages grew at their highest rate in 26 years. Export orders shattered records, and semiconductor dominance, well, that's still unchallenged. The horse is definitely galloping through 2026. But here's where it gets interesting. The same week Taiwan posted these historic numbers, the government signed a trade deal with the United States that opens nearly every sector of Taiwan's domestic market. That includes automobiles, beef, pork, medical devices, and commits 7.9 trillion new Taiwan dollars, approximately 250 billion US dollars in overseas semiconductor investments. On paper, it looks like confidence. In reality, it's something else entirely, because while the horse is running faster than ever, Taiwan is actually running out of jockeys. That's people. Retirement numbers now exceed birth. 3 to 4 jobs opening compete for every worker. And 60% of CEOs, not the general public, but the people running companies, say they're pessimistic about 2026, despite the boom. The trade deal everyone's celebrating isn't about opening markets Taiwan wants to protect. It's about acknowledging markets Taiwan can no longer staff. Hi, you're listening to Beyond the Reefs, a show produced by Radio Taiwan International. Here we talk about socioeconomic issues that are faced by Taiwan and their broader impact around the world beyond the reefs of this island nation.
Cars have become the latest point of debate in Taiwan about its upcoming trade deal with the U.S. Taiwan's lead negotiators are now in Washington to finalize the deal, which is expected to be signed on Thursday afternoon local time. The deal would see U.S. tariffs on most Taiwanese goods lowered from 20 to 15%, and Taiwan would commit to $500 billion US dollars in chip investment and financing in the U.S. But reports indicate that Taiwan's tariffs on U.S. car imports could drop from 17.5% to zero. Unions are worried about the impact on Taiwan's auto industry workers. Taiwan's economy ministry says the auto tariffs are still being negotiated with Washington, and it plans to set aside funds to cushion potential blows to local manufacturers. Whatever the outcome of the negotiations, the cabinet says it will explain the deal to the public once it's signed, holding press conferences in both Washington and Taipei.
Let's start with what everyone saw. On February 13th, Black Friday, Taiwan and the United States signed what officials called a milestone trade agreement. The U.S. tariff rate on Taiwanese goods capped at 15%, matching Japan, South Korea, and the European Union. Semiconductors get the most favorable treatment under Section 232. An additional 2,072 Taiwanese products, accounting for nearly 20% of total exports to the U.S., will be exempt from reciprocal tariffs entirely, subject only to standard most favored nation rates. Vice President Zheng Li-wen stood in Washington and said the deal meets nearly all of Taiwan's objectives. The cabinet called it highly favorable, and on the surface, sure, average U.S. tariffs on Taiwanese goods dropped from 35.78% to 12.33%. That seems to be a win. But then you read the rest. Taiwan eliminated or reduced 99% of its tariff barriers on U.S. imports. Cars, 17.5% tariff, gone. Beef, pork, medical devices, pharmaceuticals, market access granted with minimal restrictions. The quota on U.S.-made vehicles, which had shrunk to just 75 units per importer per year, now lifted entirely for vehicles meeting U.S. safety standards. And then there is the investment pledge. $250 billion US dollars. We've been talking about this for a while, but this is a big number. Committed to semiconductor, energy, and AI infrastructure in the United States over the coming years. Not we might invest, not we're considering, it's fully committed. So Taiwan gave 99% market access and pledged $250 billion. Actually, it's $500 billion because there's another 250 in government-backed liquidity or investment. The US gave Taiwan the same 15% tariff rate it already gave Japan and South Korea. The asymmetry is stark. This isn't a negotiation where both sides walk away with something new. This is Taiwan paying subscription fees to keep a relationship that was already running. And that would be strange enough if Taiwan's economy were struggling, but it's not. It's booming. Wages up, exports up, growth at 40-year high. So why did Taiwan, from a position of relative record strength, just open nearly every domestic sector and commit massive capital outflows? Well, for one, most of that growth was going to the US anyways. But the answer isn't in a deal, it's in what's happening inside Taiwan. Here's a number that doesn't make headlines but should. In 2024, for the first time, Taiwan's annual retirement numbers exceeded annual birth. Between 110,000 and 120,000 people retired, and around 100,000 babies were born. And that birth number, it's projected to drop below 90,000 in 2026. This isn't a distant demographic forecast, it's present tense. The labor market has already inverted. According to Job Platform's 104, its latest survey, the supply chain ratio across most job categories now sit below 1. That means job opening exceeds available workers. Software engineering, 0.34, 1 worker, nearly 3 jobs. Manufacturing operations, 0.28, 1 worker, more than 3 jobs. Sales and retail, 0.19 and 0.1 respectively. At the extreme end, that's 10 job openings for every 1 person willing to take them. Now, take that in for a bit. Taiwan didn't slowly age into a labor shortage over decades. It hit the wall fast, and the wall is getting higher. Every year from now on, retirements outpace births by a widening margin. The 15 to 64-year-old working age population peaked in 2015 at 17.37 million. It's down about 1 million since then and still falling fast. The consequences are cascading. Restaurants in Japan close not because business is bad, but because they can't find staff. Taiwan is heading in the same direction. Nurses are leaving the profession faster than nursing schools can replace them. 1/3 of new hires quit within 3 months. Public bus drivers are aging out. The average age hits 50-year-old, and new applicants aren't filling the gaps. Even the national military is struggling to meet its staffing targets. Enlistment rates are at historic lows despite salary increases. And it's not just blue-collar service work. The shortage extends into engineering, technical roles, and management. The pharmaceutical industry, electronics assembly, logistics, everywhere you look, it's the same story. There's not enough people. Taiwan's economic boom is happening in an economy that's running out of workers to execute it. And labor force is shrinking while demand for labor is exploding. That's the inversion. And once you see it, the trade deal starts to make sense, sort of, in a way that the official press releases don't capture. Now here is where it gets uncomfortable. Taiwan's economy grew 8.63% in 2025. We covered that before. The stock market hit record highs. We also covered that before. Wages grew at the fastest pace in a generation. And when pollsters ask CEOs, the people who are running the capitalistic machine driving its growth, how they felt about 2026, 60% say they were pessimistic. Not cautiously pessimistic, not wait and see pessimistic. About a year that's starting with every economic indicator flashing green, they're downright pessimistic. The data comes from a survey by Commonwealth magazine, and it shows something deeper than sentiment. It shows a structural split. 4% of companies now report negative investment growth, up from 1% in 2020. The number of firms reducing headcounts has returned to 2019 levels, even as unemployment remains historic low. The explanation is rather simple. Taiwan's economy is a single-engine aircraft, and the engine is obviously semiconductors. Electronics and components now account for 72% of Taiwan exports. Traditional manufacturing, like textile, machinery, plastics, the industries that once employed hundreds of thousands, has collapsed from 48% of export value to just 28% over the past 4 years. If you're running a traditional manufacturing business in Taiwan right now, you're facing impossible math. You can't hire workers because they're all going to TSMC, MediaTek, or the supply chain around them. You can't raise wage fast enough to compete with semiconductor firms paying around $83,000 per employee in annual bonuses alone. And if you could, there aren't enough workers in the market to hire. Not enough good ones, maybe. So traditional industries are dying not from lack of demand, but from lack of supply. They can't produce because they can't staff the production line. And that's why CEOs are pessimistic. They're watching the horse gallop, but they're not on it. They're standing in the stable, watching it leave. And this is where the trade's real function becomes visible. When Taiwan agrees to eliminate tariffs on U.S. automobiles, U.S. beef, U.S. pork, U.S. agricultural products, it wasn't sacrificing thriving domestic industries. It was acknowledging industries that were already bleeding out from labor shortage. The concession was a, funeral, but not a compromise. Let's talk about what the $250 billion in semiconductor investment actually means. It's not just money, it's production capacity leaving Taiwan because Taiwan no longer has room, physically or demographically, to hold it. TSMC's expanding fabs in Arizona, Japan, and Germany. Foxconn, Wistron, Quanta are setting up AI server production lines in Texas. Delta Electronics, suppliers, logistic firms, they're all following, not because Taiwan kicked them out, but because Taiwan ran out of space and people to support their growth. The trade deal formalized this exodus by committing $250 billion in U.S. investment. Taiwan isn't just securing a market access, it's securing an exit route for companies that have no other choices. When your domestic labor force is shrinking, when the average age of your manufacturing worker is climbing into the 50s, when you have no land to build more factories, then you don't expand at home. You really can't. And it's not just semiconductor companies. The construction industry is following the same pattern. Taiwanese developers are now building rental housing in Kumamoto, Japan, near TSMC's new fabs. They're building apartments in Phoenix, Arizona. They're investing in industrial parks in the Philippines and Malaysia. Because if Taiwanese companies are going abroad, Taiwanese developers want to house their employees themselves. This entire ecosystem is migrating. And here's the strange part. This might not be bad. Singapore did something similar. With a small domestic population and limited land, Singapore turned its people into premium exports. Highly trained professionals who cycled through international postings and brought capital, expertise, and network back home. The Taiwan model might be Taiwan's future, a generation of engineers, managers, and specialists who spend their 20s and 30s in Phoenix, Kumamoto, and Munich, and return with experience and wealth to anchor Taiwan's role as the strategic brain of a globally distributed production system. But that model only works if Taiwan remains attractive to come back to, and right now the signals, they're mixed. Wages are rising, yes, but so is inequality. The top 10% of earners capture 48% of total income, if not more. 70% of workers now earn below the median, and housing? Forget it. Engineers in Hsinchu are buying parking spaces for $47,000 because there's nowhere left to park, let alone live affordably. The trade deal opens Taiwan's borders because Taiwan's best and brightest are already planning their exit, and the question is whether they will come back. There's one more detail worth mentioning. South Korea signed a similar trade deal with the United States last year. Their parliament delayed ratification. President Trump responded by raising tariffs on South Korean goods, and the message was quite clear: sign fast or pay. Taiwan's deal now goes to the legislature for approval, and while Vice Premier Chen said the U.S. negotiators tried to make the deal conditional on legislative approval, Taiwan pushed back. Still, everyone in Taiwan's government knows what happens to South Korea. The implicit threat doesn't need to be spoken. This is what a subscription model looks like. Taiwan isn't paying once for market access. It's paying continuously. Through open markets, through capital commitments, through legislative speed to maintain a relationship that Taiwan can't afford to lose. Because if the US market closes, where does Taiwan's single-engine economy go? Not China, because cross-strait tensions, supply chain diversification, and national security concerns have made that path increasingly unviable. Not really Europe, it's too far, too fragmented, and its own semiconductor ambitions are right there. Not Japan nor South Korea, they're competitors in the same space. The US is Taiwan's largest direct customer now, surpassing China for the first time in decades. Taiwan's trade surplus with the US hit $150 billion in 2025 and is projected to exceed $200 billion in 2026. That dependence is Taiwan's leverage and Taiwan's vulnerability. The trade deal reflects both. It's leverage because the US needs Taiwan's chips for AI, defense, and economic competitiveness, but it's vulnerability because Taiwan has no alternative buyers at this scale. And here's the kicker. Taiwan is locking in this dependence at the exact moment its domestic capacity is maxing out. The trade deal doesn't just open Taiwan's consumer markets to US goods, it opens the door for Taiwan's production to leave permanently. The $250 billion investment commitment isn't a down payment on future growth, it's an acknowledgement that future growth can't happen on the island. So when officials call this deal a milestone, they're right, but it could be a milestone on a one-way road. Once production leaves, it usually doesn't come back. Once the jockeys move to bigger stables, the original one becomes a museum. Now let's go back to the horses. In Chinese traditions, the horse symbolizes progress, energy, and a refusal to stand still. Taiwan's economy definitely has that energy. It's moving faster than almost any developed economies in the world, but horses need space to run. In Taiwan, 36,000 square kilometers, population shrinking, labor force in structural decline has run out of space. The trade deal isn't a choice between openness and protectionism. It's the recognition that the stable is too small, and the horse has already kicked down the door. Taiwan's companies are leaving not because they want to, not because they have to. The labor is not there, the land is not there, the physical capacity to continue expanding domestically doesn't seem to be there. And so the deal does two things. First, it secures preferential access to the market where Taiwan's exports are going anyway. Second, it formalizes the capital flow that are already happening, semiconductor fabs in Arizona, supply chains in Texas, developers following engineers to Kumamoto, Japan. The deal doesn't create these trends, it simply acknowledges them. But acknowledgement does have some consequences. Once Taiwan's semiconductor production is substantially located overseas, Taiwan's leverage shifts. It's no longer the irreplaceable manufacturer, it's now the R&D hub, the design center, the strategic coordinator that's still valuable, but it's a different kind of value. And it's a value that depends on Taiwan continuing to produce the talent that makes the whole system work. Which brings us back to the labor crisis. If Taiwan can't staff its own domestic industries, if retirement exceeds birth by growing margins every year, if the best engineers are spending their careers in Phoenix and only coming home from Lunar New Year, what does Taiwan's long-term position look like? Maybe it looks like Singapore, a small, wealthy hub that punches above its weight by exporting expertise, or maybe it looks like something else. A production system that started on an island but no longer needs the island to function. So the horse is running. The question is whether the stable can keep up or whether it's already become a memory of where the horses used to live. Taiwan's trade deal isn't a misstep. It's not even a real choice. It's the formalization of constraints that were already binding. Labor shortage, physical limits, demographic declines, and the attempt to turn these constraints into a strategy. Regardless, we hope that 2026 is a great year ahead for Taiwan, so we hope you make a lot of money, as we say, 恭喜发财. May the year of the horse bring you room to run and the wisdom to know where the race is going and when the race has already started. Thank you for listening to the show. I'm Joey Chow. Tune in next week to find out about socioeconomic issues that are faced by Taiwan and their broad impact around the world beyond the reefs of this island nation.